In the first slide, we are looking into the background of the company of the Enron, which is Enron Corporation is situated in Houston, Texas, was an American energy, commodity and services multinational company. Enron was a multinational energy corporation founded back in 1985 when Houston Natural Gas Company and Omaha-based Internorth Incorporated merged. Kenneth Lay, the former CEO of the Houston Natural Gas, became Enron CEO and chair after the merger. Enron, a significant energy, natural gas and telecommunication and pulp and paper firm with claimed revenue of about $101 billion back in 2000, being employed roughly about 29,000 of employees. Enron is regarded as one of the largest corporations in the United States history. However, Enron, on the other hand, declared bankrupt in December 2001 as a result of its false accounting techniques or false accounting schemes. Enron declared financial status was sustained by an organized, systematic and intelligent planned accounting deception which became known as the Enron scandal at the end of 2001.
Assalamualaikum, my name is Syed Muhammad Zakir bin Syed Farak and I will discuss the issue in Enron that cause of bankruptcy. For the first point is truthfulness. According to Kurt Hansen, Executive Director of the Makula Center for Applied Ethics, the lack of honesty by management concerning the company's health. Enron senior executive thought that they had to be the best at whatever they did in order to maintain their reputation and remuneration as the country's most successful CEO. The responsibility is to act in a good faith and provide all relevant information. There is no proof that Enron CEO revealed that he was selling shares when he assured employees that the stock would most likely increase. Furthermore, unlike in the most cases, the employee would not have been informed of the stock sale within days or weeks. Only the investigation into Enron bankruptcy allowed shareholders to hear about the CEO's stock sell-off before February 14, 2002, when it would have been revealed otherwise. The stock was sold to the business to repay money owing to Enron by CEO, and the sale of the company shares qualify as an exemption to the usual director and officer disclosure requirement. It is not required to be disclosed until 45 days following the end of the fiscal year of the company. For the second point is conflict of interest. Conflict of interest and lack of independent monitoring of management by Enron board of directors have been blamed for the company downfall. Furthermore, some have claimed that Enron pay system developed a narrow focus on earning growth and stock price. Furthermore, recent legislative reforms have focused improving SPE accounting and strengthening internal accounting and control system. Author Anderson conflict of interest resulting from his double responsibility as auditor and consultant to Enron. Enron has attempted to rescue its business by spinning off several assets as investigation continue. It has filed for bankruptcy, which will allow to reorganize while remaining debt-free. Kenneth Lay, the company former CEO and chairman, has resigned, and restructuring specialist Stephen Cooper has been appointed as interim CEO. The energy trading arm of Enron was entangled in a complicated agreement with UBS Warburg. The bank will not pay Enron for the trading business, but will share a portion of the earnings. For the third point is reputation of Enron and external auditor affected. The disclosure of accounting problems at Enron in the third quarter of 2001 drew the attention of authorities and the media to Anderson as an external auditor. The scale of the reported accounting mistake, along with Anderson function as Enron auditor and the considerable media attention, appear to create a compelling environment in which to investigate the influence of auditor reputation on client market price in the aftermath of an audit failure. They look at how Anderson client stock price led to various information events that might cause investors to reconsider their perception of the company. The firm admission on January 10, 2002, the staff had deleted documents and communication relating to the Enron engagement was perhaps the most damaging to Anderson's image.
The first discussion question is what is the role and responsibility of the chairman and the chief executive officer or CEO pertaining towards integrity perspective. Based on the discussion question, we able to came out with discussion objective, which is to determine the role and responsibility of the chairman and the CEO according to the scope of corporate governance and understand the practice of transparency and integrity towards the shareholder of the company. Moving into the next slide, the first literature review is based on the case study of Enron. First, we are looking into the context of understanding the roles and responsibility of both the chairman and the CEO. As regard for the chairman, a chairman of a company is required to display a good leadership and governance to the board of directors as to enhance the effectiveness as well as address appropriate issues with the board during the meeting. Secondly, a chairman also must be able to promote good relationship and encourage for open discussion with the top level management. Next, the chairman is also responsible in providing a full report or clear information and highlight on the issues arising to the board in order for the board to discuss the issues and make corrective action plan. As being at the highest level, chairman need to establish good corporate governance practices which promote and display standard of integrity by avoid of any conflict and self-interest during working. As for the CEO, the responsibility of the CEO of the company is to lead the management level in day-to-day operation and conduct proper implementation of business plan as been discussed and approved by the board of directors. Besides, CEO also must maintain good communication with the chairman regards of the issue arising and well mentioned to the board attention. The CEO need to ensure that the board of directors are receiving full report pertaining of the company overall performance that relevant and having clear information of financial statement of the company. The CEO also consider part of the management level as they review and manage financial and human resources within a company. Secondly, we can refer in terms of the corporate culture, in which the corporate culture play an influence in affecting the corporate governance practices. By having good understanding and proper practices of corporate governance within the company, thus indirectly it also can affect productivity and the performance of the company in achieving their long-term objective and goals, as well as short-term goals. As regard in the next slide, the first application to the case study of Enron, the Enron controversial issue can relate with the context of incompetence of the chairman, which is Kenneth Lay, and the CEO, Jeffrey Skilling, whereby both not able to perform their duties and responsibility according to MCCG 2021 guideline and lack of understanding in terms of their responsibility as supposedly mentioned in MCCG. In a sense, both of them stated as contravene the action based on Companies Act 2016 and MCCG 2021. First, we can refer on the MCCG 2021 Practice 1.2, which stated that chairman of the board is responsible in promote good corporate governance practice. Based on the Enron case study, the chairman failed to establish a good corporate governance practice within the company. Secondly, we can refer on MCCG 2021 Guidance 1.2, which highlight the key responsibility of the chairman, such as lead the board regards to the adopting and implement good corporate governance practice within Enron in order to avoid of increasing or bear with huge risk afterwards. Secondly, in Guidance 1.2 also encourage for the communication with the board, which is the management, as well as with the shareholder during the meeting, by providing with clear and accurate information and full information analysis of the financial statement of the company. The third, we also can refer on the MCCG 2021 Guidance 3.1, which define that all levels of the management, including the chairman, CEO, and CFO, to maintain a higher standard of integrity by follow the code of conduct and ethics as been set by the board. The reason is to minimize the risk, avoidance of potential conflict of interest, corruption, unethical behavior, and most importantly is to ensure all levels of the management compliance with the law and regulation as stated within the company.
The next discussion question will be, what are the roles of board of director and top management in understanding and exercise their roles and duties with Enron. The discussion objective will be to understand the duties, roles and responsibilities of the board of director in relation to the issue concerning company's management activities. According to Companies Act 2016 under Section 211 subsection 2, the board has the power that related in managing, directing and supervising the business affair and management with subject to the company modification, limitation or company constitution. Under Section 213 of Companies Act 2016 subsection 1, the director shall exercise their power in accordance to the Act for a proper purpose and in a good faith in the best of the company interest. And under subsection 2, a director shall exercise reasonable care, skills and diligence with the knowledge and skills and also the experience. Under MCCG Practice 3.1, the board establish a code of conduct and ethic for the company and together with the policy and procedure of the implementation. There will be two types of board under the German board model, which is supervisory board and management board. Supervisory board are responsible in appointing and dismissing the member of management board, determine management composition, overseeing the function of management, reviewing and approving the financial report, appointing, retaining, compensating and overseeing the external auditor, establish, monitor, committee and also communicating with the stakeholder. As for the management board responsibilities, they shall be responsible in managing the company, reporting to the supervisory board, prepare financial statement, establish and monitor internal control, and also reporting the company's performance. As for the application in the case study, Enron controversial issue was started from the incompetence of the board and the board are not able to perform and understood their duties. The failure of Enron board of director clearly can be said as contravention action of the Companies Act 2016 and CCG 2021. The failure can be seen through the director conflict of interest, where the director neglecting the Section 213 subsection 1 of Companies Act 2016, where the director shall exercise their power in accordance to the Act for a proper purpose and in a good faith in the best of the company interest. Instead of preparing an accurate financial statement, Enron had failed to disclose adequate financial statement to the public, to the company and also to the shareholder. Other than that, Enron had engaging in high-risk accounting without any skills, knowledge, and experience, which contravene with Section 213, Subsection 2 of Companies Act 2016, where a director shall exercise reasonable care, skills, and diligence with the knowledge, skills, and experience. Lastly, the supervisory board of Enron failed to perform their responsibility in terms of determining management composition, where their supervisory board of director had excessive executive composition, which led to the failure in monitoring and performing the management performance.
The last discussion question for Enron case study is: did external auditors actually play their duties and power, and what are their roles in the context of corporate governance? The objective of the question is to understand the duties and power of external auditors in relation to the issues concerning company management activities, as well as defining the roles of external auditors in the context of good corporate governance practice. Responsibilities of external auditor in maintaining good governance. First is for risk assessment and mitigation planning. According to Ferreira, external auditors can help ensure good corporate governance by developing efficient crisis management plans to be used in the event of allegations of corruption or fraud. Corruption and fraud are risks usually dealt by corporation, but even so, besides assessing potential risk, auditors also analyze the overall risk tolerance of the firm, as well as all the initiatives the company has made toward mitigating risk. In addition, external auditors help promote corporate governance by conducting period risk assessment. Second is to promote accountability. The external auditor would facilitate a situation whereby managers are encouraged or compelled to be held more accountable. Through an appropriate application of accounting policies, the external auditor could help facilitate a position whereby creative accounting practices and hyperinflation or inflation of figures are discouraged. Penalties could be imposed on managers and directors who intentionally or recklessly inflate or manipulate accounting figures and financial statements. Such penalties could arise in the form of a reduction of such managers and directors' annual bonuses, remuneration, or even pensions. Other role of external auditors are to represent interests of shareholders, crisis management, and maintain strong relationship with regulators. External auditors had contributed to the fall of Enron Company when the external auditor did not play their role, of which external auditors may recommend penalties for officers who manipulate financial statements by cooking accounting numbers or inflating figures. External auditors review the security measures that the firm has in place against corporate fraud or corruption. Also, for the position of external auditor itself, when external auditor fails to act responsibly, according to MCCG Guidance 9.3, in assessing the suitability, objectivity, and independence of the external auditor, the audit committee establishes policies and procedures that address, among others, the criteria to guide decisions on the appointment and reappointment of the external auditor. The criteria should include an assessment of the competence, audit quality, and resource capacity of the external auditor in relation to the audit. The assessment should also consider information presented in annual transparency report of the audit firm. If the audit firm is not required to issue an annual transparency report, the audit committee is encouraged to engage the audit firm on matters typically covered in annual transparency report, including the audit firm's governance and leadership structure, as well as measures undertaken by the firm to uphold audit quality and manage risk.
Moving on to next is recommendation on Enron issues. First recommendation is Enron should have adapted a progressive, adaptive culture. This culture emphasizes new idea generation and open to new idea. It does not force staff to execute the suggestion, thus it does not promote harmful rivalry. It would also have been crucial for the company to consider cultivating a community-oriented culture, which focus on ensuring a high degree of employee engagement and cooperation. Adoption of such culture would have been critical in providing direction to employees. Second recommendation is Enron should have incorporated a accurate method of reporting. Enron should have used the accurate method of reporting to ensure accurate representation of the company worth in order to ensure successful reporting. Third recommendation is the firm should have adopted a more current control system. In terms of control problem, the company should have reviewed its policy, process, and the rule and implemented a more current control system. Integrity and ethics should have been the center of the policies and process. The company should have been more strict in enforcing ethical standards and procedure to keep personnel from acting unethically. For the conclusion, we can say that the Enron incident have served as a lesson to many people throughout the years. Some people are learning what they shouldn't do with their business and what they should do with some of their accomplishment. It become a critical instrument for identifying critical warning in a firm, such as workplace ethic and unethical behavior, moral concern, corporate work, and most significantly, business and how it operates in our society. For the development of their business, company must understand their law, rule, policy, and process. When everything fails, they must have individual willing to take responsibility and know who to contact. Not everyone succeeds, and it's even more difficult when doing legally.